Welcome back. Today we are undertaking a pretty complex and high-stakes analysis. We're zeroing in on a company that really represents both the promise and the peril of the sustainable food movement. I'm talking about Beyond Meat. This firm was once a true pioneer, commanding massive enthusiasm, but now it's trading near its all-time lows.
That's absolutely right. And this isn't just a review of a struggling stock. It's more of a mission to cut through the significant noise and, frankly, the genuine corporate drama surrounding this name. Beyond Meat has just executed some truly radical corporate maneuvers. I'm talking about an unprecedented capital restructuring. So our goal is precise. We need to figure out if these massive disruptive changes create a real, albeit very high risk, investment case.
Or if they're just the clearest signals yet of a deeper financial and operational distress that's just going to continue to plague the stock. Okay, let's unpack this. We have a mountain of fresh financial data, intricate details on that balance sheet overhaul, that massive debt swap, and then a critical look at the technical signals. We're going to start, as we always do, with the fundamental numbers, the cold, hard truth. And we'll dive into that financial engineering and finally look at what immediate catalysts might move this stock in the near term. Let's start with the top line. I mean, revenue is the fuel that powers every business, right? Especially one that needs so much R&D and marketing. Where is it trending? Is that plant-based boom still happening for them?
The trend is concerning, and crucially, it's been persistent now for several quarters. We're just seeing continued top-line contraction. If you look at the trailing 12 months of revenue, it's sitting around, what, $290.57 million?
Okay, and where was it before?
Well, compare that to the $343.38 million they brought in during 2023. That is a noticeable steady decline. The core message is stark. In their central markets, they're shrinking. They're losing ground, not consolidating it.
Right. And when a company shrinks, the immediate hope is that maybe they're becoming leaner, more efficient, sacrificing growth for margin. But when we look past revenue to the bottom line, profitability, is the company anywhere close to turning a profit? Or is this something much deeper than just growing pains?
Unfortunately, the losses they're still astronomical. It's not just a lack of profit. It's being deeply, deeply entrenched in the red. Net income remains extremely negative. It's clocking in around negative $237.7 million on a trailing 12-month basis.
Wow, $237 million. To put that in perspective, that translates to an earnings per share, or EPS, of what?
Negative $3.18.
That is a staggering loss figure, especially relative to their current revenue. That's like losing almost $1 for every single dollar of sales they bring in.
Exactly. And here's where the outside perspective really matters. Analysts are consistently revising their estimates downward. The consensus is pretty clear. They just don't see an immediate, reliable path back to profitability. And that persistent loss connects directly to their financial strength, or, lack thereof.
Which I imagine is also just completely constrained by this environment.
Yeah.
If you're burning cash at that rate, your flexibility must be non-existent.
It is severely constrained. With that ongoing high cash burn and the persisting operating losses, their liquidity is exceptionally tight. So the priority shifts completely from expansion to simply, preserving runway. This is why you can't expect strategic moves like stock buybacks or meaningful R&D expansion. Every single strategic move they make, including that debt swap we'll get to, feels incredibly high stakes because they're managing a severe cash shortage.
So if the numbers are this bad, we have to look at the competitive landscape. I mean, this company was the face of the plant-based revolution. Does that first mover status, that brand recognition, still count for anything?
It absolutely still counts, but you need to see it as a valuable asset that is rapidly depreciating. Beyond Meat still has phenomenal brand recognition. It has that first mover advantage globally and an established international presence that a lot of rivals just don't have. Those are huge strategic assets that still offer some intrinsic value.
But the erosion of that asset is where the problem is, right? Where are they losing the battle?
It's really a dual attack. First, you have weakening consumer demand across North America and key European markets. Consumers, facing economic pressure are trading down. And second, there's aggressive competitive encroachment, especially from private label innovation in the big grocery chains. Store brands are now offering cheaper, often comparable, plant-based alternatives.
So they're getting squeezed.
Totally squeezed. They have the brand, but they don't have the pricing power or the growth volume to leverage it. It leaves their competitive advantage under just significant strain.
Okay, so that paints a picture of a company in acute operational distress. I suppose that's exactly why they had to resort to this extraordinary restructuring then. This wasn't some minor tweak. This was a complete overhaul of their capital structure. Tell us about the sheer scale of the balance sheet surgery they performed.
What's so fascinating here is that the restructuring, it wasn't optional. It was absolutely necessitated by the operational failure we just outlined. In September and October, the company launched and completed a massive $1.1 billion exchange offer for its outstanding convertible notes.
For those who might not know, what exactly is a convertible note and why was this such a crisis?
So a convertible note is basically debt that gives the holder the option to convert it into common stock. The problem was they had a huge amount of these notes coming due, and they simply didn't have the cash to pay them back. So this exchange offer, it was a desperate measure. They were settling old debt by offering creditors a mix of new secured convertible notes and, crucially, new common shares.
So they kicked the can down the road on the debt, buying themselves time. But they paid for that time with a dilution bomb for existing shareholders?
Precisely. The cost was astronomical. The transaction finalized in October added 317 million shares to the outstanding count.
317 million.
You cannot overstate the impact of this. It fundamentally shifts the math for every single existing shareholder. If you owned 1% of the company before the swap, you now own a tiny fraction of that. And on top of that, they created new warrant liabilities that are nearing $15 million, which just muddies the equity structure even more.
And this whole restructuring came right alongside some pretty shaky Q3 financial instability. I remember hearing about a delayed filing, which, always raises red flags.
Yeah, the delay of the Q3 10Q filing was directly related to the complexity of all this and a major financial event. They had to finalize a material, non-cash impairment charge. That charge ended up being a steep $77 million.
A non-cash impairment. So what were they impairing? Inventory, goodwill. And why does a charge that doesn't involve immediate cash cause such alarm?
They were impairing the value of long-lived assets, so likely tied to inventory, equipment, things like that. And while it's non-cash, it's a critical admission. It means the company looked at its assets and had to concede, these things are not worth what we said they were because our future business prospects are much worse than we thought. That $77 million write-down contributed heavily to a disastrous net loss of $111 million on only $70 million in revenue for that quarter.
Wow.
And to keep the lights on during this, the company had to fully draw down a $100 million term loan. It just shows the acute need for liquidity. This wasn't a strategic move for expansion, it was a scramble for survival.
And if that wasn't enough, there's also this lingering legal cloud, right? Adding uncertainty to future cash flows.
Absolutely. There's a significant ongoing dispute with a contract manufacturer claiming at least $73 million in damages. Now, the company is defending itself aggressively, but any adverse ruling would immediately present a critical risk to their cash flows, which, as we've established, are razor thin. It's a material risk you can't ignore.
So let's look at the internal motivation here. Amidst all this instability and shareholder dilution, management gave themselves a massive stock grant. Why is the vesting date on those restricted stock units, the RSU, so important for the average investor to watch?
This is where management's short-term focus really crystallizes. These were massive RSU grants. The CEO got 4.4 million of them. But the crucial detail is their singular vesting date. All of them vest on December 31st, 2025. This is framed as a critical retention effort, keeping the leadership team incentivized through this instability.
So if I'm reading the tea leaves correctly, management's financial fate is now completely tied to the stock price surviving and maybe even recovering before the end of next year.
That's exactly it. For an investor, it means management has a massive incentive to do whatever it takes in the short term to shore up that price. That December 31st, 2025 date isn't just an arbitrary entry, it's a key psychological and financial event for watching management's focus.
All right, let's shift gears and look at the technical picture. We've established the fundamentals are collapsing and the balance sheet needed radical surgery. So where is the market actually pricing all this risk?
The price action just underscores the extreme risk. The stock is trading near its all-time lows, hovering around, $1.09. It's dropped a staggering 98% from its peak, and we've seen extreme volatility. The 52-week range stretches from 50 cents up to $7.69. That just tells you there are massive speculative forces at play.
When you look at the technical snapshot, does it suggest any kind of bottoming process is underway? Or is this just continued downward pressure?
The persistent bearish momentum is just It's unmistakable. The price is trading well below both its 50-day and 200-day moving averages. And being that far below the 200-day signals that the long-term trend is powerfully and consistently negative.
We often talk about trend strength when we look at technicals. What does the average directional index tell us about how committed the sellers are?
The ADX, it confirms a moderately strong downward trend. This is crucial because, while the stochastic indicator is technically oversold,
Which usually means it might be due for a bounce.
exactly, it's at 14.1, suggesting sellers have been maybe too aggressive in the very short term, but we have to treat that signal with extreme caution. The ADX tells us the overall direction is still firmly negative, so any minor bounce is likely just a short-lived reaction inside a much larger downtrend. The bears are in firm control here.
Okay, what about Wall Street? Are analysts scrambling to find a floor for this, or are they abandoning ship?
The analyst view is overwhelmingly negative. The consensus is sell. About 60% of analysts rated a sell or a strong sell. The remaining 40% are at hold. No one is issuing a buy recommendation right now, but what truly stands out is the extreme dispersion in the 12-month price targets.
Tell me about that. I saw one number that was just baffling.
They range from a modest $1.70, which is just above the current price, all the way up to a highly speculative high of $77.74.
$77. I mean, that requires a multi-billion-dollar turnaround or an acquisition. What on earth is driving that outlier?
It's pure, unadulterated M&A hope. That's it. The market consensus really questions the credibility of those high forecasts. They rely entirely on a highly unlikely scenario of a high-premium acquisition by a major food conglomerate.
So given the volatility, are institutional investors, the big money, stepping in to catch this falling knife, especially after the restructuring?
We haven't seen any meaningful positive institutional flows. In fact, we've seen declining holdings among major funds. And critically, there has been no discernible insider buying reported in 2025. So that tells you that neither the smart money nor the management team is deploying new cash to support the stock at these low levels.
But the retail crowd, the forums, they must be buzzing about this name.
Oh, very active, yes. Retail sentiment vacillates wildly between calling it a deep value opportunity at $1 and issuing dire warnings about bankruptcy risk. And there's the constant recurring buzz about potential buyout offers. But it has to be stressed, for you listening, that this is purely speculative noise without any credible confirmation.
So given this extraordinarily high-risk, high-volatility setup, what are the concrete short-term events that investors should be watching over the next 3 months?
There are 3 key events that could drive extreme volatility. First and foremost is the Q4 earnings report, expected around February or March of 2026. Given the depressed price, any reversal, even a small one toward revenue growth or a narrower loss, will drive massive upside volatility.
And the other two relate directly to the restructuring and the insiders, right?
Yes. Second, you have that critical vesting of the insider RSUs on December 31st, 2025. That compensation event could significantly influence trading dynamics. And third, the institutional disclosures, the 13F filings expected in January 2026. Those will reveal which major funds adjusted their positions after that massive capital overhaul, and that will be a crucial barometer of professional investor confidence.
So let's talk about the long-term speculative upside. Is there a genuine path for recovery here, beyond just a highly unlikely M&A event?
The primary hope, as we've said, remains M&A, which is highly speculative. The secondary path would involve a broader macro rebound. We would need to see a future demand revival, maybe fueled by shifting consumer preferences back towards premium products or renewed ESG concerns, or just improving economic conditions so consumers can tolerate that higher price point again. That's the only way the business model can naturally return to growth.
But we have to finish by reiterating those operational risks. They fixed the balance sheet, sort of, but what is the biggest hurdle they still face in the business itself?
The single biggest company-specific risk remains that declining demand in their core markets. That's the engine that's seized up. That operational failure is coupled with the rising liquidity risk from the ongoing cash burn. So they're traded extreme debt risk for extreme dilution risk. They did all this complex balance sheet engineering, but they haven't fixed the core problem. Consumers aren't buying enough of the product.
So what does this all mean for the listener? What's the final practical thesis?
Based on the current risk profile and the fundamental shrinking revenue, staggering losses, severe dilution, the overall bullish rating we'd assign is low, maybe a 3 out of 10. This is absolutely not recommended for conservative long-term investors until a concrete, proven fundamental turnaround in revenue is underway. Right now, this stock is suitable only for high-risk, event-driven speculation in the short term. You're just betting on one of those key catalysts materializing.
That puts everything into very sharp focus for anyone looking at this highly volatile name.
It does. And maybe here's a final thought for you to consider. Given the extreme dilution and the massive debt restructuring they just finalized, you have to ask yourself, what fundamental operational shift, beyond just the constant M&A rumors, would the company need to announce in Q4 or Q1 to genuinely prove that its brand can save its flawed operational strategy? At the end of the day, we need to see sales velocity, not just more financial maneuvers.
A great challenge for management and a key metric for all of us to watch. Thank you for guiding us through that complex situation.
My pleasure.
We'll be back soon with another exploration of the market's biggest stories.